This episode of the Commercial Real Estate Investor Podcast is brought to you by Hamilton, a value-add investment and development firm in Nashville, Tennessee, focused on bringing passive real estate investment opportunities directly to your inbox. Visit www.investwithhamilton.com/invest to sign up for upcoming investment opportunities. Welcome back to the Commercial Real Estate Investor Podcast. Really excited to be here today with my good friend Dylan Marma. We actually had him come and speak as a guest at the Bigger Pockets Beginner's Intro to Commercial Real Estate Investment course that I taught. And I was like, man, we haven't had Dylan on in quite some time. Last time he was talking about raising a fund. And today I want to dive into the RV parks, the cabin campgrounds, and as well as the mobile home park side of his business that he has going on. Brief introduction for Dylan, for those of you who are not familiar with him. He's the founder and CEO of the Requity Group, which is a vertically integrated real estate private equity company that sources and operates large manufactured home communities. And when he says large, he means large. And RV and cabin campgrounds with in-place cash flow and upside. In the last 5 years, he's completed over $100 million in acquisitions on the owner-operator side through a combination of direct ownership and syndications. Dylan, obviously that was a very brief reintroduction of you to much of my audience, but tell us a little bit about yourself and your background.
Yeah, sure thing, Tyler. Thanks for having me on the show. Always a pleasure to chat with you and connect with the audience here. I mean, you pretty much gave the big highlights, but I've been full-time, like you mentioned, over 5 years now in commercial real estate. I took sort of an alternative path. Something that you and I share is that after 2 years in going kind of the traditional route, going off to school, I ended up leaving school. I was from upstate New York, moved out to sunny San Diego with this whole dream of building this lifestyle by design. I knew I wanted to get in real estate, didn't know anything about real estate at the time, started working for a real estate investing company. And I was fortunate that they really started to partner with a lot of large scale syndicators and operators, I should say, and they started to raise money for these operators. So got to look at a lot of different business models, really fell in love with the whole idea of growing a business. I don't even love the term syndication, but growing a business where we're running an investment company, partnering with high net worth investors, and being able to create the opportunities that we're able to create. So sunk my teeth in. Started off with multifamily. Never I ended up finding a couple partners that had an existing portfolio, hadn't raised any capital. I had been studying the model for a few years at that time, so I kind of came in as the young, hungry kind of sweat equity to be able to help source deals, put systems in place to raise capital. Together, we went out and did over 750 doors of multifamily. And then after a couple of years of that, ended up going in different directions. And that's when I started the Requity Group, which is where we are today. Started also looking into the manufactured housing or the mobile home park space, which also led us into RV Campgrounds, another business that operates similarly but has its own nuances. Now today we are approaching, probably in less than 2 months, we'll be at over 2,000 total sites, and are really loving the industry, and we got a team with over 30 people. We are vertically integrated, so we run all of our own property management, similar to as you do. We are currently all acquisitions. We don't do any development like you guys just yet, but we're hoping to get there. But yeah, right, we're buying good parks, making them great, and just working our magic on the operation side.
Yeah, there you go. I love it, man. I've got to ask, how does it feel going off on your own after working with other people for so many years?
Yeah, I mean, it's I think that looking back in this business, I oftentimes just am fascinated by how random. How many random events, interactions have sort of influenced my trajectory over time? Right, it's definitely never crystal clear on what your future is going to look like, what your business is going to look like. After parting ways with my partners, it was mainly just because I wanted to continue to grow in sort of the real estate private equity model, and I probably also had more of a bug to explore some additional facets within the real estate world. So I think these are natural parts of a partnership, right? It's hard to have complete alignment at all times. So I think it was a natural kind of progression. And at that time, I really didn't know what I was going to do, to be honest. I actually had a bug for real estate, technology. Actually, I thought there was some opportunity for me in that space. I started dabbling with different projects for I don't know, maybe 6 months or so, and then I realized that I definitely don't want to run a software company or be in the real estate technology space. And then I had a lot of friends that were buying mobile home parks, and I was in Knoxville, Tennessee at the time, and I'd met Jim Clayton. I had a lot of friends that were early into sort of the wave of mobile home parks. They were complaining about how you couldn't get 20% cash on cash returns anymore, and I'm sitting here like I'm looking for a good 6 or 7 on a going in on a value add multifamily. So how are you gonna complain to me about that?
I
So
feel so bad for you.
yeah, I was like, how are you? And then, so I kind of had that light bulb moment where I said, maybe I should start asking more questions. If these guys are, still finding returns like that looks ridiculous compared to multifamily. Then I realized that the average residency is usually 15 to 20 years on a tenant-owned mobile home, and you don't have the constant, gut punches of HVACs blowing and roofs needing to get replaced and all of the things that multifamily brings with it, especially when you're dealing with older product types. So I think I had that light bulb moment, and sure enough, I don't think I was the only one that had that light bulb moment. And the industry's gotten a lot more competitive since we started, but it definitely was a great window of opportunity to kind of give us a lift off.
Yeah, I mean, these alternatives within the alternative, which is real estate, are infinitely intriguing to me. I mean, you look at self storage, for example. I mean, they had the same thing, right? They started complaining like, oh, you can't get 20% cash on cash returns anymore because people finally started to realize like, oh yeah, multifamily is not the only option when it comes to these larger scale investments. Let's look at self storage. Let's look at RV parks. Let's look at mobile home parks. I mean, there are so many different ways to make money in this business, and that's what I find so fun. Serge is saying, looking forward to this. Thanks for continuing to put out this informative content. Absolutely, Serge. Glad you're with us, man. So, Dylan, tell me a little bit about the differences in the model between multifamily and let's start off with mobile home parks because I feel like a lot of investors out there are very familiar with multifamily and how that works. So, what are the big
Yeah.
differences, and how do mobile homes work?
I mean, there's a lot of similarities, so much to the point where when we're training analysts, like we're onboarding one right now, we're teaching a multifamily first, right? I just think it's such a great way to sort of get the basics down. And there's a lot more educational content out there to kind of get the basics. There's a ton of deal flow to model. So, and you usually have a little bit more information. All your financials aren't on the back of a napkin on a multifamily deal. So it's a little bit easier to kind of get your bearings, I think, to just learn how that works. I do suggest, if you're not sure kind of what product type to explore, I think learning multifamily makes a lot of sense. Especially if you're looking at any subset of multifamily. So in terms of the big differences are just the ownership of the physical real estate itself, right? The beauty of the mobile home park world is that your base long term, your goal is usually to have a pure resident owned home community, right? So for me, being a multifamily guy, we jumped into a lot, plus mobile home communities where we owned all of the homes, and at that point, we would go in and we'd renovate the homes and then sell them off to, for a profit. And it's really not, it doesn't have to be a huge profit, but more so we could transfer the ownership to a high quality resident. And then they would take ownership of the home, meaning therefore they are responsible for all deferred maintenance, all of the floors, the roofs, the HVAC. And then in exchange, we get a lower rent amount, but the rent amount is going towards what we call lot rent. So the lot rent is covering us for being able to mow their lawns, keep up with the community, the roads, the signage. We do a lot of guest or resident events. So we're there to really create true community, and that's where a lot of our focus ends up going. And the beauty is that, like I mentioned, the average stay is 15 to 20 years once they own their home. It's very costly to move their home out. It can be, $5,000 or $6,000 just to move to another community. So they usually stay there for a long time. And that means that for us, it's very, very sticky income stream. I'd say it's, in my view, stickier than multifamily. Multifamily has shorter term leases, more ebbs and flows, and you have a lot more of those heavy capex needs where you have to, invest, $1 million into improving the property every 5 to 7 years, just to kind of keep it up to date with the modern demands and the deferred maintenance and things along those lines. So these make for really great long-term hold assets. I think multifamily, you want to, I like to wear both hats and be able to argue the strengths of each. Multifamily, there's definitely more liquidity out there. There's just more it. So you have, if you ever need to sell, it's going to be a little bit easier to sell. There's also more debt options available. You can get debt product like no other in traditional multifamily. So it's really hard to compete with the amount of options that you're going to be able to get on the product. And multifamily is more of a transactional velocity kind of business. With these mobile home communities, what's going on right now is everyone, because they're great long-term hold assets, everyone's holding long-term. And then you're not seeing as much product hit the market. Whereas multifamily needs that facelift every 5 years. So most big buyers are transactional, and they're buying, they're driving value, and they're selling to maximize their IRR. Whereas you don't see that nearly as much in the mobile home park space, right? If you do see a sale, it's usually they gobble up a huge portfolio and then they sell off as like a giant, 1,000 site portfolio to an institution. Those are kind of where we are. I like to call us like the consolidators. We go out there and we'll get scrappy and write the smaller checks so that we can one day have a portfolio that a REIT might have interest in.
Yeah, I'm a much bigger fan of that strategy. I've never really enjoyed the whole private equity 3 to 5 years. Let's get in there, let's squeeze the blood out of it and flip it as quickly as we can and move on to the next one. I just think that model of real estate, while it is profitable and there is a reason that people do it, it's not really good for the long term. You can only really do that to a property or to a community so many times before it becomes a problem. Whereas, if you're coming in and you know that you're going to be owning an asset for 20 plus years, you're just going to treat it differently. You're going to fix things the right way. You're going to deal with the tenants the right way instead of, terminating leases, kicking people out and raising rents. So I think that's a great way of approaching it. And it makes sense that, you would have these 15 to 20-year tenants, right? Especially now you look at it, even in Nashville. I mean, down the street, there was a, 300 unit, 200, 300 unit mobile home park that got torn down. They're building 700 apartments there. And as these higher and better uses come along, quote unquote, you're starting to see developers paying absurd numbers for the land and just getting rid of them. And so they're going to have fewer and fewer options to leave. Is that kind of what you're starting to see?
Yeah, definitely. So to your first point, I heard a quote or I heard someone say recently, so I'm not going to take credit for it, but they said they like to, operate their real estate like a Honda, sort of, and just like take good care of it and just take make it last a long time, right, to get over the 200,000 miles, right, versus like revving the engine and just trying to pump and dump every so often,
Yeah.
right? So I think that really resonated just with like gradual, constant improvement, over time, in terms of how you think about your, capex and all of that. And then to your second point, yeah, the supply is they've basically historically there's been a negative net supply year over year, where because there are instances like what's going on in that community in Nashville, people are tearing them down for higher and better uses, or maybe the old owners that inherited the place are just letting it run to the ground, and people are buying it up and turning it into something else. So you do have a dwindling supply. And the other reason for the dwindling supply, because you would question, well, why don't they just keep building these? It's because a lot of the nimby laws, right? A lot of people are prideful homeowners, and when you ask them if you can build a mobile home park in their backyard, there's a lot of pushback around that, right? Because they say, well, that's going to lower my home's value, or I don't want, again, this is, I hate to stereotype, but there might be people out there that say, I don't want my kid riding to the riding to school with the people in there, right? Like there's just a stigma, and it's unfortunate because this is one of the most viable solutions for affordable housing. And I think a lot of people have a misinterpretation of what the reality looks like with the people that live in the manufactured housing communities, and yeah, so I think you're dealing with that. And that said, though, I will say there's been more development recently. We are looking at two pieces of land in specific counties in Florida right now that we're hoping to be able to get approval on developing. And one of the counties has expressed they're very open to it. So there are areas that you're going to be able to develop. I'd say that historically it's been much different because back when these things traded at 8 caps, you could never make sense of the economics in the areas that would approve it. But now that you're talking about a 5 cap exit, or you're going to get twice as much per pad, now that 40K all in that it might take to build up a nice pad with nice paved roads, et cetera, you might be able to sell that for 80. So now the spread is really significant, and I think that's where a lot of the smartest people in the industry are starting to kind of move towards that because of that.
Yeah, I think NIMBYism is certainly an issue when it comes to mobile home parks. I remember 5 or 7 years ago, this group out of Nashville, New Frontier Tiny Homes, they used to, maybe they still do make them, but they used to make these amazing tiny homes. I mean, just incredibly well crafted. And it was like, I looked at buying one. I thought, wow, these are so cool, but they're 100 square feet. They tried to build a community of those. And these are $100,000, like very nice, relatively relatively high end tiny homes, but because they were on wheels and you could take them across the country with you if you ever decided to move, Metro Nashville did not want to rezone anything for what they considered to be a mobile home park. And it's that's exactly what you're dealing with on the development side. There is that it's just tough to go out and get land zoned for this anymore, which is just crazy to me. Ken Ward is saying, in Oklahoma, looking to network with you gentlemen. Ken, thanks for joining us. Feel free to jump in with any questions you got. Ria's got a question. Dylan, this one's going to be a good one for you. Is a 5-acre mobile home park a good size? There is one for sale about 2 hours from my primary home, but we are concerned if it's in a good area.
Yeah, so good size is all relative. It all depends. Well, there's no really bad size mobile home communities. That's the nice part, is that unlike apartments where you have to hit a certain threshold to afford an on-site manager, if it's a resident-owned home or community, it's a little bit easier to manage without having the on-site manager, because your main functions are to just ensure the landscaping is getting done and the rent's getting collected. So it's a little bit easier than running a small apartment complex. So the size I would be less concerned with, and 5 acres should be usually maybe 6 homes per acre. Maybe there's 30 total homes. We have some that are 3 homes per acre, but I'd say 6 is probably more normal for density. So somewhere in that range is probably the most likely case. Good area, that is also that is definitely important. I mean, I'd say a lot of mobile home communities in general are in tertiary markets, or sometimes rougher parts of town, because they are affordable housing communities. But it all depends on your vision for your portfolio and sort of the class that you're looking to manage, right? You may just not want to deal. We've walked away from ones that they changed the name because there had been shootings on property multiple times in the last few recent years, and it's just not something we have any interest in dealing with, right? So if it's in an area you can't, there's no coming back from, and it's sort of your low C class, D class tenant base, you might not want to for your own peace of mind. But if it's a good area, maybe we bought some that were rough resident bases out the gates. There was a lot of crime, interaction, etc. But it was a great area. They're building DR Horton right next door, building massive single family home communities. So we said, well, we that you can't change the area, but you can change the people that are living in the community. So it's been a lot of work, but we think it's been worth it.
That's great, man. I've got to ask. So, one of the most attractive features of investing in commercial real estate and multifamily real estate is the depreciation that you get from the buildings. Now, it doesn't seem to me like in most cases you actually own these. So, Do you get any depreciation? And if not, are you basically trading depreciation for cash flow with these types of investments?
So that's actually a great question, and one of the main drivers for our investors, believe it or not, is the depreciation that comes from mobile home communities and RV campgrounds. They both are very similar in terms of the way that they depreciate, but generally we see about double what you'd see in any multifamily investment when it comes to
Really?
depreciation. Yeah, it's the number one type of real estate when it comes to depreciation. We have a lot of active investors that flip homes, that do multifamily, that are building hotels. We have a lot of active investors that come invest with us because they want the offset on their real estate professional income. So the depreciation, the way of course, you'd scratch your head and you say, well, how in the world, if it's just land, on the buildings, how is that possible? Well, I think you got to look at the breakdown of how these are valued and sort of what the replacement cost would be. Because generally, if you're buying, and again, I'm not a CPA here, I'm not, of course, run all this through your CPA, get their sign off, before you make any decisions or take my word for any of this. But just for example purposes, if you bought a mobile home community or an RV campground that are land lease businesses, say 40,000 a lot. That's kind of fair. There's a lot of stuff trading around there in today's world. Then you got to look at how much would it take to develop this from scratch. It would probably take about $40,000 a lot. What's that money going towards? It's going towards your water infrastructure, your sewer infrastructure, your road infrastructure, your signage. And it just so happens that all of those items that I just listed are on the 5 or the 15-year depreciation schedule, right? And there's none of those items are on the 27.5-year depreciation schedule.
And they're
So
very expensive.
yeah, they're very expensive. So, and if you own the homes, you actually get less depreciation because you're going to have more of it on the 27.5-year schedule. So it's going to take longer for you to realize the losses. But if you don't own the homes, you're getting really high depreciation because you're also buying in a lot of times secondary and tertiary markets. In a tertiary market, the land might only be worth 10% of your purchase price, right? So because the land is so low in value in a lot of these, and the infrastructure makes up the majority of the value, and it's on such a fast depreciation schedule, we've seen over 100%, consistently over 100% of our invested dollar as a loss year one from depreciation.
That's awesome. I would never have expected that.
Yeah.
That's a great little nugget right there for anybody interested in investing in RV and mobile homes. That's a pretty big one right there. Hey, Joey is asking, Dylan, would you consider investing in a luxury motor coach resort near Nashville? Lots with outdoor kitchens and pavilions.
Absolutely, I love the idea of that, and we've wanted to do something like that. I think timing wise, there's a lot of uncertainty in the market, so we've kind of held back from jumping into it right now. But 100% long term, we'd like to be able to develop luxury motor coach communities where you can sell off some of the lots, sort of like a condo, to be able to recoup some of your initial equity, and then hold some of the lots and run like a professional management business around it. I think it's a great model.
Yeah, I'd have to go back and look. I'm pretty sure Joey shared that project with me. And I told him, I was like, this looks 100% like something that we would do. It's just not really within our purview. Like the way that it was designed and how cool and different it is. I was like, we would totally do this. It's just not really in our wheelhouse. So Joey, thanks for jumping on. Dylan will actually probably be a very good connection for you on that project. Dylan, I can share that with you and connect you guys via email after this. It's a pretty cool deal. I've got another project that I met with a guy about. It's a hotel that he wants to add in something similar out near Dixon that I'll connect you with afterwards. So that kind of leads me to my next question. So besides people jumping in and pitching you deals live on my show, how do you go and find mobile home park investments?
That's the only way. So
Gonna keep coming
it's
back on.
exactly. It's pretty much right now we do a lot of cold calling. So we have someone that calls, tries to make 100 calls a day, just to other owners in different parts of the country, and that's our number one direct marketing outreach. Every deal we've done in mobile home parks has been off market. So, it's been all either direct marketing through cold calls or through other people we know that are calling or mailing, or through brokers that we know, off market. We do put a lot of offers out there on market stuff. It just hasn't really hit yet. We have bought 2 RV campgrounds on market just because we think the industry there's just not quite as many buyers out there right now. So we've been a little bit more competitive with some of the on market stuff there. But the mobile home parks, we haven't gotten anything on market yet.
Man, there's not a lot of people out there, and you're on this show sharing your secrets. No, that's
Yeah.
awesome, man. Well, cool. So once you find these projects, how do you perform your due diligence and make sure that how do you underwrite it? How do you do your due diligence? Because I know, like you kind of alluded to earlier, a lot of it is back of napkin or cash. I mean, that was one thing that always scared me off from actually investing in mobile home parks was a lot of the tenants paying cash. A lot of the owners don't actually report the true earnings, and then they want these crazy numbers. So how do you investigate that?
Well, the biggest challenge with that too is we're dealing with one right now. It's a smaller one for us, but it's the lady hasn't done taxes in 2 years, I don't think, and
That's a problem.
we have no records of her financials, and we're just dealing with how do you get the bank comfortable with it, right? That's the hardest part, right? We can get comfortable with it to some degree because we own the area, we know what the income should be and the expenses should be, but we don't have any tax returns. It's hard to get the bank there, so. Thankfully, having a good bank relationship is so key in this industry, because it's mostly a lot of recourse debt through either niche or community banks that you're going to be able to go in with on these value add deals, and then you can always refi into non-recourse. But the key is getting a good bank for sure, and then also learning up on seller financing. In this case, I think we're going to have her hold like a small note on top of the bank to be able to get the leverage that we're targeting. But yeah, that's challenging. And then the other, probably the bigger challenge on RV campgrounds specifically. I know we haven't deep dove into that yet, but the RV campgrounds are tough because they're just a little bit more of their own beast in terms of like the way that the numbers work. Mobile home communities are pretty linear in terms of their income and their expenses, and they're pretty overall predictable. RV campgrounds can be a little bit more difficult because you have more of a short term, either monthlies, weeklies, nightlies, alongside your annual site agreements. So it can be harder to predict your income. And then on the expense side, it's hard to always be able to analyze and determine what are their personal expenses, their personal car payments, personal insurance, et cetera, and break that apart from their actual business expenses, and then try to paint the picture of where the kind of the value add could be, and what the future looks like.
So when you're underwriting these, do you look at it as if it was an apartment complex? I mean, is it almost a similar process there?
Yeah, it's almost the same. I mean, it's the same like base model, right? It's the 10-year model, and we have our income, and then we have our expenses, and actually we use the exact same expenses. This might just be like more specific to us. I'm sure other groups have different GL, different chart of accounts that they're going to be running their books off, but just to keep things congruent, we use the same payroll, G&A, contract services, you know taxes, management, insurance. It's same exact like chart of accounts pretty much. There are definitely, when you break down our sub accounts, there are definitely a lot of nuanced accounts that we have, but the model is very similar, but it's just different rules of thumb that go into each of them. And then the income streams can be a little bit different too. One of the tricky ones is when you own mobile homes, the park owned homes usually don't factor into your income and expenses. So we create like a whole separate P&L for the homes and show those selling off at the value of the homes. And then we show the real estate selling off on a cap rate. Kind of confusing, probably spend an hour on that alone, but for the most part, it's very similar.
Yeah, that's great. So let's dive into RV parks and cabin campgrounds, because I know that that's something that you've started focusing on here pretty recently,
Mhm.
or fairly recently, relative to your mobile home parks. Talk to us about why you decided to start looking into that asset as well.
Yep. Yeah, so I'm just doing the quick math. We are at seven, I would even say 7.5 RV campgrounds because one of ours is half mobile home, half campground. But we're at seven, pure RV campgrounds at this point, and we have two under contract right now. So yeah, we've definitely been moving into this space pretty aggressively, just as we've been finding a lot of great mom and pop opportunities that are presenting just better risk adjusted returns than we're able to find in most areas of real estate. We try to run our portfolio, and we've been doing pretty good at sticking to this thus far, at more of like I call it like a 70-30 model, in terms of the 70%, trying to maintain around 70% of the portfolio being what our annual site agreements, and then about 30% being sort of our short-term rental, more hospitality-driven RV campground side of the business. I think it allows us to have majority of our income coming from like a really sticky source of annual site agreements, people that are going to live there long term, or at least keep their camper there long term, I should say. And then you have some that are there for more of the hospitality reasons. But I'll even take a step back and just start with, what is an RV campground? RV campgrounds are they can be misunderstood because I think everyone has a different picture that comes to mind. Some think of a KOA, some think of which is like a popular short-term rental campground. Some think of a man camp, which is like a utility workforce campground that sits outside of uh, oil and gas rig or something like that. And then some think of your high-end motor coach campgrounds outside of Nashville, right? So, but they all represent the same thing, which is a place where you can have RVs, different from mobile homes, which are the actual RV that's able to drive into the campground, or park model cabins, which are probably what Tyler was referencing before. They're 399 square feet, and they're built up to RV code, so they're, from a zoning perspective, which I love, you can interchange them, and they're going to be treated exactly the same from any planning and zoning board, right? So you have a mixture of park model cabins and RVs usually, that occupy the community, and they're usually with the intention of it being a temporary living situation, not a permanent living situation. That's important to note, because the eviction process is very different. It's usually still on hotel motel laws, where you have a 24-hour process if someone's just not meeting up to code, or they're causing a scene. You have a little more flexibility with being able to ensure everyone's keeping up to code and not dealing with the evictions that you have with traditional residential living. A lot of counties might have different rules. Some counties you can't keep someone there for more than 30 days. Some counties are totally fine with that. So it's really, really county specific, probably more than different asset classes. You really need to get to know the planning and zoning and understand kind of the nature of the place you're looking at investing into. But yeah, I, I guess I'm trying to look for direction as to which areas you think are going to be most beneficial to dive into for your audience first.
Yeah, I mean, whatever you think. I wanted to talk about raising capital next, because I know that you're raising capital for these deals, and you've got investors in them. But I mean, in terms of just the long term investability of RV and cabin campgrounds, I mean, obviously you've got to see that going up as the years go by. That's why you guys are jumping into it, since you're a long term holder. But let's talk about that.
Yeah, so let's start. Yeah, let me start with some of the stats that I think everyone would appreciate understanding as to why we're so bullish on this right now, and where we believe the industry is going. Um, One, there's numerous reports out there that are projecting a 6 to 7% compounded annual growth projections over the next 10 years. And that's a lot of that's measured off of the increasing demand in campgrounds, as well as RV campground sales. RV campground sales have went up tremendously since over the last 10 years. In 2009, there were 165,000. In 2022, there were over 600,000 RVs ordered. 9% of households in the country own an RV. There's 11.2 million households in the country that own an RV.
Did you just say
There's
9% of households own an RV?
Yeah, I thought that was pretty fascinating too.
Wild.
Yeah, it definitely is really dependent on where in the country you are, because it's down here in Florida, it's super popular. I remember I feel like up in New York where I grew up, I didn't see it nearly as much. So then you have right now there's over a $14 billion backlog with Thor Motors, which is the largest manufacturer of RV. They own Jayco, they own Airstream, they own a lot of the major brands that people are probably familiar with. So you have a giant back order. People RVs haven't received yet, right? Which is just the demand is just seeping through the pores in terms of people that are looking for places to go and camp. 97% of campgrounds are mom and pop, non-institutional ownership, and that's extremely apparent. A lot of them don't even have websites, doing any online marketing. A lot of low-hanging fruit, easy upside just from building an online presence as a professional operator. There's $8 billion of annual spending on RV campgrounds. And yeah, I think that when you look at all of this combined, and if I always recommend if you really are serious about exploring this industry, just go watch videos of campers and if you either experience the camping life for yourself. I wasn't a camper prior to starting to look at this, but I've been out to different campgrounds, rented RVs numerous times, and just of course from being on our own campgrounds, really got a good feel for what people are looking for. But when I was first starting to look at this, I started just watching YouTube videos. Right, there's a ton of vlogs out there, and that are just they're talking about their experiences at different campgrounds, what they like, what they don't like, and you're going to see that there's a common theme that a lot of people are complaining about how crowded campgrounds are right now, how hard it is to find a spot, and in the peak seasons, they're having to schedule months, even sometimes over a year out on a lot of these popular campgrounds. So there just aren't enough quality campgrounds right now, campground sites for people to meet the demand. So I think that's changing the way people are camping. Obviously, it's really good for us as investors, because that one that could be an increased rates, but also it means that we think that more people are going to start resorting to um, doing more of the annual site model, which is our bread and butter. Right, we find usually great located properties that are on the ocean or nice bodies of water, and people can pay for the year up front or pay for a month at the campground, and then they will leave their camper there all the time and just drive up on the weekends and have it be like their lake house, so to speak, right, or ocean house, right? So we find these are really sticky. We like the ones that have like marinas on them with wet slips, or some kind of boat launches, and that's really been where the majority of our focus has been. Is I don't know, it fits us well.
Yeah, that's really interesting. I like too how you're diversifying your portfolio at that 70-30 split by keeping the more stability as two and a third times the more volatile yet potentially higher income producing side. I mean, to me, like that seems like a very well balanced portfolio. I've got to share this because I just think that this is hilarious. Improved 2022 said, "Is this millionaire single? I love white, cute, rich guys, or I'm so attracted to white, cute, rich guys." I bet you anything that's Mike Taravella. Just
I think that's definitely Mike. And Mike, no, I'm not. And let's try.
yeah, neither of us are. Sorry about that. Rhea, before we move on to capital, Rhea's asking, would you mind sharing where we can find RV parks and campgrounds for sale, both off or on market? Sounds like off market. You just got to sit down and make the phone calls.
Yeah, you can find there. I mean, definitely just Google RV campground brokers. There's a number of brokerages that specialize in these campgrounds. I don't want to favor anyone and give you any names right now, because we're not picking favorites. But definitely just Google them, and you'll find a number that specialize in this asset class. That's your Honestly, it's not that competitive yet. I think that could always change, but right now, I think if you're really serious, start looking at the on-market deals, and then also start calling around for off-market deals, and find what works for you. I would say my biggest advice to anyone is just don't get too blinded by the potential returns. Look at the risk and the downside first. Like I think that in this space is more important than in a lot of other product types. We've walked away from stuff that we could have gotten for like next to nothing on a price per site, And it could have been like 100 IRR because we also could have lost money if the demand kind of wasn't where we thought it might be. So we really like to look at major MSAs, ideally 200K plus MSAs. Like I mentioned, we like to look at being having nice natural amenities around. In a perfect world, it's something that people could always live in as affordable housing if things get really ugly. And that would be my biggest advice. Just be really smart and thoughtful about the location.
Yeah, I think that's a point that I try and hammer home here all the time. And especially, on the brokerage side, we're helping investors place their capital into some of these deals. And, you know, everybody wants to get 8 caps, 9 caps, 10 caps. It sounds sexy, right? Because you're like, oh, look at how much it's going to cash flow. But there is a reason it is such a high cap rate. If that seller thought that they could get a lower cap rate and increase the value of that property, they would be doing it, right? Like there is a reason that these assets have higher cap rates. It's because they are inherently higher risk, and it's like real estate development. Can you get amazing returns in real estate development? Absolutely, but you can also lose everything. So it's important, as Dylan was saying, to keep the risk adjustment in mind. Evan's asking, do you look for city water and sewer at campgrounds, or is that not 100% required?
To me, it's definitely not 100% required. I know some people are super adamant that everything has to be on public utilities. We're not afraid of septic tanks. Probably half our portfolio has septic tanks. We know how to inspect them. We know how to check them out. It's knock on wood, never really been a huge issue. We've replaced a couple here and there. We've done a ton of pumping the tanks all the time, but it's we've gotten pretty comfortable with that. We do have 2 treatment plants at this point. Funny enough, one of ours is on an apartment complex, which is uncommon, and then one of them's on a RV campground. But those can be. I think those require even more close eye and inspection, and the right third party team to maintain them. So definitely do even more homework when you have those. On the septic tank side, it's better to have more septic tanks than less, right? If you have 100 sites, I'd want to see 100 in a perfect world, 100 septic tanks rather than having 100 sites on 2 septic tanks, because you're going to get a lot more angry people calling you in the middle of the night. And it's just harder to replace and deal with, in that kind of situation. You want to make sure you have extra replacement area. If it does bust, you want to make sure you have the CapEx reserves on the sidelines and the replacement area to fix it. Well water, again, for us, not a huge deal. Get the right inspection, ensure the pressure is where it needs to be to serve the community. But we've also been doing this for a bit now, and we definitely feel like we've done a lot of homework to get comfortable with those. So if you're starting off, it's definitely preferred city water, city sewer, but I'm open to private if it checks out well. We've also walked from deals though where the inspections don't work. So just do your homework.
Wonderful. Let's talk about funding these deals. So I know on the equity side, you come from a background of syndication. You've done a fund. So how are you raising capital to go take these projects down?
Yeah, so we've done a lot of funds. We're on our 3rd fund right now. We're rounding up our 3rd fund. It's 10 million. Actually closing out this week. But that has that's been good. That was sort of how we got our start. Mostly was just through small funds, and then we also would do some individual raises, or I call them SPVs, that will either co-invest with deals that the fund will own, so we don't over invest into one deal, for instance, because its goal is to be diversified. And then we also do individual deals. We're at this point in time, we're sort of really evaluating where we want to go from here. I think the fund model can be really valuable, but we also are starting to really, just for bandwidth and just in terms of like fitting the vision of our company, we're strongly considering just exclusively doing larger projects that will require 10 million plus deal sizes. And if we do that, it may be more it may fit our model more to go back to individual deal raising versus doing funds. Whereas in the beginning, we were sort of going after opportunistic smaller deal sizes. So having that kind of capital streamline the process. It allowed us to do deals that would have been like 5 times oversubscribed had we brought them to our investor base and allowed the investors to all get a piece of a collection of these smaller deal sizes. So I guess there's pros and cons to both models.
Yeah, that makes sense. What about on the debt side? I mean, what are you seeing typically for your lending terms, the loan to value, interest rates, length, amortization, all that kind of stuff?
On the debt side, we are seeing usually, and if something's got good cash flow and you can support the DCR requirements, 70%. Sometimes we've gotten higher, up to 80. But usually we're modeling at 70% loan to value, and we usually try to go for loan to cost and get an as completed appraisal in place to show what our post renovation valuation could be. That's usually modeled so 70 LTV, 70 LTC on that. On the amortization side, we've been lucky with our bank to at times get 30, but I think I would probably plan for 20 to 25 if you're starting out, and I think that's pretty common. It's harder to get the 30-year amortization, and then we usually 1 to 2 years interest only, pretty common there. This is all recourse. I mean, all of our going in stuff is recourse. I've grown comfortable with that just because I believe in what we're doing, and I'm comfortable being the signer on all these deals. Just kind of shows how much conviction I have in the projects that we're taking on. But there are non-recourse options available. There's CMBS available. You just have to deal with a heavy prepay, so it sort of becomes more difficult to kind of pencil out your timeline. Life insurance is also available for both MH and RV at a certain size as non-recourse. There's a couple, I've recently seen some debt funds that are non-recourse, usually a higher rate. And then there is agency available for MH product. You can get agency debt. It just has to be less than 35% park-owned homes, and it has to sort of check a bunch of boxes in terms of the overall aesthetics and the layout of the community and things like that. But agency is, of course, a great option when you get the community up to par.
Awesome, Dylan. Well, we have surpassed the 45-minute mark. I know you've got a lot going on that you got to get back to. If anybody watching wants to get a hold of you to invest in the fund or to talk to you about some mobile home park or RV and campground offerings they may have, how can they get a hold of you?
Yeah, you can check out the requitygroup.com. Also, you can follow me on LinkedIn or Twitter, and those are the best ways at this point. If you want to subscribe to our list or opt in as an investor, even if you're not interested in investing right now, we should have content and newsletters getting sent out occasionally to kind of keep you engaged with what we have going on.
That's great. Dylan, this was an awesome conversation. Thanks for coming on, man.
Yeah, always a pleasure. Thanks a lot.
All right, we'll see y'all later. Thank you for listening to the Commercial Real Estate Investor Podcast, brought to you by Hamilton, your resource for passive real estate investment opportunities. Visit www.investwithhamilton.com to start building your passive real estate portfolio today.